What's up everyone, it's Kadi with Money Investing. In this video, we are going to be talking about the US housing market. So our focus is going to be on real estate since I am personally planning on actually buy real estate at the end of this year, early next year. So I'm not in a rush. I'm going to be very patient, and I'm very closely watching some metrics in the US and expecting for the prices to roll over at some point later this year. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time, and link to our Discord and Patreon is going to be down below. First week of the month, usually the best time to join. You can get access to all the buy and sell alerts, options alerts, trade ideas, all the member benefits, including private videos as well. And the fundamental and technical analysis courses, the bundle is currently 60% off. Coupon code is going to be Easter if you want to take advantage of that. Both links down in the description below. So Robert Schiller, who has been, created the Schiller Cape ratio, the price to earnings multiple on the S&P 500, a lot of really cool and interesting metrics for the US markets. Pretty much mentioned at the end of March that housing prices are still very high, so hold off on buying as US economy will keep struggling. And there are some very interesting data points that I want to show you, but US house prices still look very high. According to Robert Schiller, maybe if you have a good chance of delaying your purchase, it might be a good time to do so. And he also mentioned that U.S. house prices still look very high, so potential buyers should consider delaying their purchase for another 6 months, with the economy struggle likely to continue. And he also mentioned that home prices are very high by historical standards. Now, there's another one. Before we get into that, he also mentioned that I would extrapolate the downturn somewhat. It's going to continue. And maybe if you have a good chance to delay your purchase, it might be a good time to do it. It might get a little cheaper after another 6 months. So just like what we have in the stock market, looking at price to earnings, right? So we look at price of the actual index with respect to the actual earnings for the S&P 500. In the housing market, one of the indicators that I'm really focusing on is price over income, right? Which pretty much tells us how expensive real estate is now starting to get relative to earnings. In other words, income for households, right? So what we really do is we take into account the median home value, or the price of the home, divided by the actual household median income, and we arrive at a ratio. Just like the S&P 500 is trading at 19 or 20 times earnings, it's trading at a 20 times multiple of actual earnings. That's how we look at the US housing market as a whole, on aggregate price to income. But before we get there, this right here is 2023 jobs growth by region reported by ADP. And what's really interesting is that you are seeing job losses in the Midwest, such as Montana, Idaho, Wyoming, Nevada, Arizona, New Mexico, and then even in the Sun Belt area in the West South, Central South, and at South Atlantic, a lot of job losses in those particular regions. We're still seeing job gains in Mid-Atlantic, New England, the Northeast, and the West Coast. We're still seeing a lot of job gains. Now, over time, in my personal opinion, as time goes on, as 2023 progresses, we will start to see the labor market also weaken in the Pacific areas, such as California, Oregon, and Seattle, Washington, and then also in the New England side and Mid-Atlantic, and in the Northeast as well. And as job losses actually take place, and we learned more about that unemployment report yesterday, even though it continues to show us a very strong labor market, 3.5% unemployment rate, there was 2 categories which I specifically mentioned, construction and manufacturing, that did decline. And that is usually one of the first leading indicators of a potential recession if infrastructure starts to slow down. Now, this right here is another really interesting chart which shows us that rental affordability is superior to mortgage affordability at present, and this hasn't really happened since the 1990s. So what this chart shows us is that 40%, almost 40% of income is actually going towards a mortgage payment, whereas opposed to 25% of income is going towards a rent, right? So there's a big discrepancy between affordability for a home versus renting. So renting a home clearly makes a much better choice as a percentage of your income with respect to paying off a mortgage, especially if there is going to be concerns over a recession and higher levels of unemployment later this year. Now, this is coming back to the price to income chart, which I mentioned, so price over income. And historically, we have been on average around 4 to 5 times, right? This is going back as far as the 1960s. And during the housing bubble, this right here was the housing bubble bursting in 2005 all the way through 2009. We see the home prices relative to income get up to over 7, right? And if you take a look at where we are right now, as of 2023, we are at over 7.7. And what's even worse is there are specific states in the US that have price to income ratio at over 8, 9, 10, even as much as 12 to 13. So this is a spreadsheet that I created, which pretty much goes over the median home price, the median household income, the 5-year change, and the price to income ratio. So what's really taken place is that prices have gone up too much, too fast relative to the actual earnings and income. And this one shows us the over 30% of income on mortgages, right? So what percentage of population is paying over 30% of their income on their mortgage? So as you can kind of go down the list, you'll notice that there's a lot of Californian cities such as Los Angeles, San Francisco, Oakland, San Jose, Long Beach, Anaheim, San Diego, and those are pretty much it. All Californian cities that actually have a price to income ratio of over 10 to as much as 11, 12, 13, and 35 to 40% of the income going towards a mortgage, right? So, or in other words, 35 to 40% of the population is paying more than 30% of their income on their mortgage. So that's pretty substantial numbers if you think about it. And if the layoffs continue in the tech sector, which is very much concentrated in California, it is possible that we start to see people move out of state and lots of increased supply in that particular market as well. This right here is going to be small and mid-sized cities with the highest home price to income ratios. And again, you can see that there's cities, even Glendale, Sunnyvale, there's some cities that are even as high as 12 to 15 times. Berkeley, California, over 16.6. Burbank, California, 14.8. I mean, affordability is completely out of whack with respect to where prices are and where income levels are. Incomes have not gone up or not really kept up with the increase in overall prices. So unfortunately, the way, it all depends on whether we see a US recession or not, right? Whether there is going to be an economic slowdown with respect to higher levels of unemployment in the US economy or not. Because if we do see layoffs, right, in the tech sector, regardless of whether it's a tech sector or not, in the broader economy, if you start to see unemployment kind of spike up a little bit, considering how high rates are, and the stronger the labor market, the more hawkish the Fed, meaning the higher the rates are going to be. So if we do see layoffs happen in the US, that leads to both borrowers defaulting and tenants also defaulting, which leads to foreclosures and evictions, which obviously leads to increased inventory and potentially lower prices in the future. Because if you think about just prices in general and how much they've gone up relative to incomes, affordability is non-existent. Like you talk about, not just in the US, you talk about Toronto, Vancouver area in Canada, affordability is really not that great, because you've got prices with the average home price at over $1 million, and incomes have just not kept up with the increase in prices. So high price to income ratios also increases, or pretty much is going to lead to lower affordability, which is going to lead to lower demand, because people getting into the market now are just not going to be able to buy a home because of higher interest rates, because of higher prices, and of course because of the fact that renting is going to actually make a lot more sense. So as price to income ratios are going to be incredibly high, you've got lower affordability among borrowers and buyers in general, because obviously prices are higher relative to their income. That creates less demand, and people are going to start to migrate and look for places where they can actually buy. And this is not true for every single market out there. So I want to be very clear that I think most specifically, the more saturated, the more concentrated markets right now are in the Northeast and in the West Coast and California and New York area. But there are a lot of really affordable prices in the Midwest, especially in some of the Wyoming, Montana, Minnesota areas, and of course down south a little bit, and then down in Pennsylvania. Around those areas, there's still prices that are relatively stable with respect to their income and of course household median income, and as opposed to California and New York, that is really trading at very, very high levels. And of course, income and savings is what really drives the US housing market. That is something that we have to pay attention to, because if the savings rate is really, really low and income levels have not really kept up, It's only a matter of time when it's not going to be sustainable for prices to keep going up higher and higher like this, because you just can't keep having buyers bid up the prices because incomes are no longer going to be sustainable. And as a result, you will start to see prices roll over. Let me know your thoughts down in the comment section below. What do you think about this? I would love to learn more about where you are and what you're kind of seeing in your respective housing market. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel, make sure that you drop a like. And as always, happy investing, and I'll see you all in the next video.